In this lecture, we develop the arbitrage pricing theory, or APT. APT is an important theoretical model which relates expected returns on various risky assets to their systematic risk. In particular, APT tells us how exactly to quantify or measure systematic risk of various assets. The main idea of the APT is to start with the factor model of returns. Stock returns have common factors or systematic factors that affect a variety of assets, and non-systematic or firm-specific idiosyncratic factors that affect individual assets or individual stocks. Diversification can be used to eliminate non-systematic risk, which means that diversified portfolios are only exposed to the common sources of risk, or factor risk. This implies that risk premia, or expected excess returns, on diversified portfolios depend on their exposure to systematic risk factors. This is the main result we are going to establish. Because portfolios consist of individual assets, by forming a variety of diversified portfolios, we can show that for almost all risky assets, expected returns also depend on their exposure to systematic factors. And that is the main result of APT, that expected excess returns or risk premia on various assets are determined by their exposures to systematic sources of risk, or the common return factors. Let's start by developing a factor model. Under the factor model, stock returns are exposed to two kinds of shocks, two kinds of risk: common shocks or common factors, and asset-specific or firm-specific shocks. Let's think about common factors. These factors proxy for shocks to economic conditions which affect a variety of firms and which are important to investors. Such shock could include shocks to economic growth, shocks to monetary policy or interest rates, shocks to oil price, government policy shocks, and so forth. These are common macroeconomic shocks that affect various firms, not necessarily in the same way, but they are broadly important in the economy. As an example, consider an asset, the price of which rises when inflation unexpectedly accelerates. This kind of asset can be used to hedge inflation risk. An investor who buys this asset is going to gain some protection against inflation. As a result, we would expect that assets like these are going to earn relatively low risk premia because they are going to be in high demand by investors. The bottom line is that factors represent systematic or common sources of risk which cannot be diversified away by forming portfolios. Firm-specific events give rise to idiosyncratic or firm-specific risks. These include events like new product innovations, lawsuits, changes in management, labor strikes, and so forth. As an example, consider a two-factor model. In this model, the two factors are represented by shocks to economic growth and to energy prices. In particular, the shock to growth is the unanticipated change in economic growth, so its expected value is zero. And the same is true of the shock to energy prices. Under this model, the return on any asset is represented by its average value, Ri bar, plus the sum of two systematic terms, which are the shock to the economic growth times the loading on that shock, B, plus the shock to energy prices times the loading on that shock, plus the idiosyncratic piece, epsilon I, which represents firm-specific idiosyncratic shocks. Consider further two hypothetical firms. The first of these is the solar panel installer. This company has moderate exposure to the overall economic growth, so its loading on the growth shock is going to be positive, but perhaps not very large. This company also benefits from an increase in energy costs, so its loading on energy prices is likely to be positive and perhaps large. The second company is a long-distance trucking firm. This company is very cyclical, its cash flows are highly sensitive to economic activity, and as a result, its loading on the economic growth shocks is positive and large. This company is also negatively exposed to energy costs. Rising energy costs imply higher operational costs for this firm, and so its loading on the energy shock is negative and large in absolute value. We now take a closer look at the technical details of factor models. Let's start with the single factor model. We have a large number of individual assets, indexed by I, 1, 2, 3, and so forth. Returns on these assets are denoted by Ri tilde, to remind us that these are random, and their expected returns are denoted by Ri bar. These returns are driven by a set of common or systematic factors and by idiosyncratic shocks. We denote systematic factors by capital F. These are, for example, shocks to economic growth or shocks to the value of the market portfolio and so forth. Little f represents the news component of the common factor. By definition, little f is equal to the factor value, f, minus its expected value, f bar. In other words, little f is the demeaned value of the factor. Idiosyncratic shock of each asset, epsilon I, by definition has zero mean. The key assumption that we make for the factor model is that idiosyncratic shocks are truly asset-specific, which means that they are pairwise uncorrelated across all the assets. In other words, the covariance of epsilon I and epsilon j for two different assets, I and j, has to be equal to 0. We now describe return on any asset as a sum of its expected value, Ri bar, plus the factor f times the loading on this factor, which is asset-specific, that's b sub I, plus the idiosyncratic shock epsilon I. Under this model, the variance of returns on asset I consists of two terms. The first term reflects the amount of systematic risk to which this asset is exposed. This component of the variance is equal to the square of the factor loading times the variance of the factor. That's bi squared times sigma f squared. The second term in the variance of the asset is the idiosyncratic piece. This reflects the variance of firm-specific shocks. The covariance of returns between two assets, I and j, is captured fully by their loadings on the common factor, and this is because covariance of idiosyncratic components of returns is 0. So what we find is that the covariance of returns between assets I and j is given by the variance of the factor, sigma f squared, times the product of the two factor loadings, b sub I and b sub j. What we see is that under the factor structure, factor exposures determine how much asset returns can move with each other, and that is because factors describe fully the common sources of variation across the assets. On top of that, idiosyncratic risk of each asset contributes to its own return variance. Now we can generalize our construction to the case of multiple factors. This is in direct analogy to the single factor case. Again, each asset return is given by its expected value plus the systematic component, which is now a sum of contributions across multiple common factors from 1 to k, and the idiosyncratic component epsilon I. These common factors are going to affect multiple assets. Each asset has its own loadings on all of these factors, which we call factor betas, or factor sensitivities, or factor loadings. And we allow factors to be correlated with each other, so we don't make any assumptions about their joint distribution. As in the case of a single factor model, we maintain the assumption that idiosyncratic shocks are truly asset-specific, and their pairwise covariance across the assets is 0. On top of that, we maintain the assumption that our factors are demeaned, so that the expected value of each of these factors is 0. We now consider the key step in the derivation of the APT, diversification. Consider a portfolio that includes multiple risky assets, portfolio P. This portfolio is described by its weights, which we denote by W. The return on the portfolio is a weighted average of the returns on the individual assets. Therefore, we can derive the moments of portfolio returns from portfolio weights and the properties of the individual asset returns. In particular, the portfolio mean is a weighted average of the average returns across the assets in the portfolio. The factor loadings of the portfolio for each of the factors are also a weighted average of the individual factor loadings of the securities in the portfolio. And the idiosyncratic component of returns, epsilon p, is a weighted average of individual epsilons. It is this idiosyncratic piece that we are interested in right now. The variance of the idiosyncratic component of portfolio return is the variance of the sum of wi epsilon I, which is the weighted average of individual epsilons. Because idiosyncratic shocks are pairwise uncorrelated across the assets, the variance of this sum is equal to the sum of variances. In other words, the variance of the idiosyncratic component of portfolio return is a sum across all of the assets of the individual idiosyncratic variances, variance of epsilon I, times the square of portfolio weight. Now let's specialize this result to the case of an equally weighted portfolio. Suppose that each of the portfolio weights, wi, is equal to 1 over n, where n is the number of assets in the portfolio. We're going to need a piece of notation. We will denote the average idiosyncratic variance across all of the assets by sigma I squared bar. Now, as it is clear from the previous derivation, the variance of the idiosyncratic component of portfolio return is equal to 1 over n times the average idiosyncratic variance. As we let the number of securities increase and n rises, this number goes to 0. In other words, as we enlarge the portfolio by adding more and more assets equally weighted, the non-systematic component of variance vanishes in a limit. This result does not depend on the portfolio being exactly equally weighted. The same argument can be applied to any well-diversified portfolio, as long as the maximum portfolio weight decreases as the number of assets in the portfolio rises. In other words, all that we require is that the portfolio weights are more or less evenly distributed across the assets, but they don't need to be exactly equally weighted. What we determined is that in a well-diversified portfolio, firm-specific or idiosyncratic risk can be eliminated as the number of assets in the portfolio increases. This is an important property of well-diversified portfolios. They don't have idiosyncratic risk, at least in the limit of a large number of assets. The only risk that affects well-diversified portfolios is the factor risk or systematic risk. This is the kind of risk that cannot be diversified away by forming portfolios with a large number of assets. To illustrate, consider the following empirical example. We construct two portfolios by sorting stocks on their market capitalization or market size. We start in 1926. Portfolio 1 includes the largest stocks in the US stock market. This portfolio is based roughly on the top 30% in terms of market capitalization, judging by the distribution of market cap on the New York Stock Exchange. In recent years, this portfolio included approximately 500 stocks. The second portfolio includes the lower tier in terms of market size. This portfolio, we can call it mid-cap, includes roughly 1,000 stocks. These two portfolios are well diversified, and by construction, they do not overlap. A stock can be either in portfolio 1 or portfolio 2 or neither. They have no securities in common. If return distribution in the stock market can be described by a single factor model, then both of these portfolios, being well diversified, will have exposure to the common factor and no idiosyncratic risk. In other words, these two portfolios should be perfectly correlated with each other. The exposures to the common factor may not be the same in magnitude, but the returns should be perfectly correlated. As we look at the scatter plot of the return distribution of the mid-cap portfolio on the vertical axis, relative to the large cap portfolio on the horizontal axis, we observe that indeed returns on these two portfolios are highly correlated with each other. They're not perfectly correlated as a single factor model would predict, but the correlation is very high, and the R squared of a regression of the mid-cap return on a large cap return is over 90%. Observe that the slope of the line that captures the linear relation between these two portfolios is higher than 1. What this means is that the mid-cap portfolio has a higher loading on a common factor than the large cap portfolio. These results suggest that there is a significant common factor that affects returns on large cap and mid cap stocks, and even though these two portfolios have no securities in common, their returns with each other are highly correlated. We also see that the correlation is not perfect, and that suggests that perhaps there are other factors at play here, and a single factor model does not fully describe the return distribution of these two portfolios. We now develop a result that relates expected returns on well-diversified portfolios to their systematic risk. Let's start with an example and use an arbitrage argument to establish this kind of relation. In our example, there are two portfolios, A and B, and there is a single common source of risk. There is a single common factor. We assume that the expected excess return, recall that excess returns are measured relative to the risk-free rate. The expected excess return on portfolio A is 5%, and for portfolio B it is 8%. The loading on the common factor is 1 for portfolio A and 2 for portfolio B. We want to argue that with this set of assumptions, the market contains arbitrage. Let's consider the following arbitrage strategy. We're going to borrow $1 at the risk-free rate. We're going to short $1 of portfolio B and invest $2 into portfolio A. By construction, this strategy doesn't require any capital. We borrow $1, raise another $1 by shorting, and invest the $2 in portfolio A. Let's consider the payoff of this strategy next period. The payoff from borrowing $1 is going to be minus 1 plus the risk-free rate. The payoff from shorting portfolio B is minus 1 plus the risk-free rate plus the risk premium on portfolio B plus the factor loading, which is 2, times the realization of the factor F. This is multiplied by the scale of our investment, which is $1. The payoff from our investment in portfolio A is going to be 1 plus RF plus the 5% risk premium plus the factor loading, which is 1, times the realization of the factor F multiplied by $2. When we sum up all of these payoffs across the 3 legs of our position, we find that the effect of the factor disappears, that exposure cancels out, and we're left with 2 cents. In other words, we started with no capital and we constructed a portfolio with 3 positions in it, which pays 2 cents next period with no risk. This is arbitrage or free lunch. The reason why we were able to find arbitrage is that expected excess returns on our portfolios and their factor loadings were not consistent with each other. We will now generalize this result and establish a relation between factor loadings and expected returns, which is needed in order to avoid arbitrage. In particular, we want to show that expected excess returns and factor loadings have to be linearly related. For a single factor model, this means that for any portfolio P, the expected excess return has to be equal to its factor loading, B sub P, times a constant, lambda. This constant has to be common to all portfolios. To see why this needs to be the case, we're going to repeat the arbitrage argument similar to the one that we just discussed for our particular example. Suppose that for another portfolio, portfolio Q, the risk premium is equal to its factor loading, B sub Q, times a different constant, lambda prime. Lambda prime and lambda are not the same. Assume also that B sub Q, the loading of the factor, is non-zero. Now we create a three-legged arbitrage. We're short $1 of portfolio P. We buy BP over BQ dollars of portfolio Q. And we borrow BP over BQ minus 1. As you can see, this portfolio, this entire trade, does not require any capital. It is self-financing. As we look at its payoff, we observe that the payoff from the first investment, $1 in portfolio P, plus the second investment, the investment in portfolio Q, plus the risk-free component, when we sum them up, have the property that there is no exposure to the factor remaining, and the payoff is in fact a constant. It's equal to lambda prime minus lambda times B sub P. To avoid arbitrage, this constant has to be equal to 0. A zero investment portfolio without risk cannot produce non-zero payoffs. We conclude that lambda prime and lambda have to be the same to avoid arbitrage. We have established an important result, that in a frictionless market with a single factor structure of returns, in order to avoid arbitrage, risk premia on all the well-diversified portfolios have to be given by a product of the factor loading of the portfolio and a common constant, lambda. The factor loading represents the quantity of risk in each portfolio. It's a measure of systematic risk. Lambda tells us how much compensation a portfolio is going to earn per unit of systematic risk. We call lambda the price of risk, or the market price of risk, or the factor risk premium. Our pricing result can be extended to multi-factor models. The result is very similar. The risk premium on any well-diversified portfolio is based on its factor exposures. In particular, it is a sum across all of the common factors of the factor loading times the corresponding factor premium or price of risk. These factor exposures describe systematic risk of the portfolio. Now, in contrast to the single factor case, this is a vector. A portfolio is characterized by a vector of its risk exposures. We need to know how a portfolio loads on each of the factors to fully describe its risk. And each of these risk exposures carries its own risk premium. Different factors don't earn the same compensation for their risk exposures. The intuition of this result is that we could construct multiple portfolios with identical risk exposures. To avoid arbitrage, their expected returns have to be the same. This means that expected return or the risk premium on any diversified portfolio must be determined by its exposure to the common factors. Next, we discuss estimation of factor risk premia. How can we learn about prices of risk associated with the various systematic factors? APT relation tells us that the risk premia on various diversified portfolios are based on their factor exposures and the associated prices of risk. We can therefore use market returns, market prices, to recover the implied risk premia, which are attached to all of these systematic factors. To see how this can be done, consider the following example. Suppose we have two common factors. As before, it's a shock to economic growth and a shock to energy prices. We start with the APT relation, that the risk premium is a linear combination of factor loadings weighted by prices of risk. Now, suppose we observe two well-diversified portfolios, A and B. The expected returns on these portfolios are 12 and 10% respectively, and the risk-free interest rate is 2%. The factor loadings for portfolio A are 1 on the growth shock and 125 on the energy shock, and for portfolio B it's 2 on the growth shock and minus 0.5 on the energy shock. We want to use this data to recover factor risk premia for the growth shock and the energy shock. The APT relation tells us that the expected excess return on asset A, which is 12 minus 2%, is equal to its loading on the growth shock, which is 1, times the price of risk of that shock, which is unknown, that's lambda of the growth shock, plus 125, which is the loading on the energy shock, times the price of risk of that shock. That gives us one equation that relates risk premium on the two factors to the expected excess return of portfolio A. We do the same for portfolio B and obtain a second relation. We have a system of two equations on the two unknown prices of risk, which we can solve, and we find the unique solution. The risk premium associated with the energy shock is 4%, and the risk premium on the growth shock is 5%. To avoid arbitrage, all other portfolios must have expected returns consistent with these factor risk premia. For example, if we have a third portfolio, portfolio C, with a growth loading of 1 and the energy shock loading of 0.5, then the risk premium on this portfolio has to be equal to 1 times the premium on the growth shock plus 0.5 times the premium on the energy shock, or 7%. What we see is that risk premia associated with various risk factors can be recovered from risk premia on well-diversified portfolios. We next introduce an important concept, a factor mimicking portfolio. So far, our common factors didn't need to be traded assets. They could be macroeconomic shocks. They could also be returns on financial assets. It turns out that we can replace any common shock with a corresponding return on a financial portfolio. This portfolio is called the factor mimicking portfolio. Let's see how it can be done. Consider a case of a single factor model. We can visualize the APT relation graphically. On the graph, on the horizontal axis, we plot the factor exposure, B sub P. On the vertical axis, we plot the expected returns on the portfolios, R bar P. The relation between expected portfolio returns and the factor loading is linear. For the portfolio with zero factor loading, the return is equal to the risk-free rate. This is the point on the vertical axis. And for the portfolios with positive factor loadings, average returns are positive and increasing with the magnitude of the factor risk exposure. Consider one of these portfolios with a factor loading equal to 1. Under the APT relation, the risk premium on this portfolio has to be equal to the risk premium of the factor, or lambda. We can therefore see that the portfolio with the factor loading equal to 1, or with the unit factor beta, can be used as a factor mimicking portfolio. The risk premium on this portfolio is equal to the price of risk of the factor. Moreover, because this portfolio is perfectly correlated with the factor, we can use it instead of the factor in the APT relation itself. In other words, we can replace the factor by its mimicking portfolio in our factor model. Next, we generalize the argument to the case of a multi-factor model. We start with a model with the k factors, and we consider k portfolios, P1, P2, so forth, which are linearly independent. Our objective is to construct mimicking portfolios for each of the common factors. Once we do that, the expected excess returns on these portfolios are going to tell us the risk premia for the associated factors. To construct a mimicking portfolio for factor J, we need to build a portfolio with the property that its loading on factor J is equal to 1 and its loadings on all the other factors are equal to 0. This can be expressed algebraically as a system of equations. The factor loading of the portfolio is equal to the weighted average of the factor loadings of the individual assets or the portfolio components. In our case, these assets are portfolios P1, P2 through Pk. So consider the exposure to factor 1. We have the weight of the first portfolio multiplied by its loading on the first factor, plus the weight of the second portfolio multiplied by its loading on the first factor, and so forth. The equation tells us that the loading of the portfolio on the first factor is equal to 0. We do the same for each of the factors. Factor j is special. The loading on that factor is equal to 1. The loadings on all the other factors are 0. We have a system of equations with k unknowns and k equations. We can find a unique solution. This allows us to construct factor mimicking portfolios. To see how our procedure would work, let's apply it to our previous example. We have two portfolios, A and B, and two common factors, a growth shock and an energy shock. Portfolio A has a loading of 1 and 125 on the two factors, respectively. Portfolio B has the loadings of 2 and minus 0.5. We want to build a factor mimicking portfolio for the energy shock. This portfolio has a weight of WA on portfolio A and WB on portfolio B. It must have 0 exposure to the growth shock and a unit exposure to the energy shock. These two conditions can be expressed as two equations. For the growth shock, we have the weight on portfolio A multiplied by the beta of that portfolio, which is 1, plus the weight on portfolio B multiplied by the beta of that portfolio, which is 2, and the sum of these exposures has to be equal to 0. For the energy shock, we have similar logic. 125, which is the loading of portfolio A, multiplied by the weight of A in the portfolio, minus 0.5 times the weight of B is equal to 1. We solve the system equations to find that the weight on portfolio A is 2/3, 0.67, and the weight of portfolio B is minus 0.33. Notice that these weights do not sum up to 1, and that is because in our construction we are implicitly using a risk-free asset. So as we add up the weights, the residual, the difference between 1 and the sum of these weights, has to be invested in the risk-free asset. In this particular example, we find a mimicking portfolio for the energy factor, which has weights of 2/3 on portfolio A and minus 1/3 on portfolio B, and that implies that the risk premium on the energy factor is equal to 4%, which is exactly the same result that we found previously by computing the risk premium implied by the expected returns on portfolios A and B. We now extend the APT result to individual assets. Let's recap. So far, we established that absence of arbitrage under the assumption of factor models implies that the risk premia on all well-diversified portfolios have to be determined by their factor loadings and the risk premia on individual factors. What can we say about risk premia on individual securities? It turns out that the same relation has to apply to almost all individual securities. This result is what is called the arbitrage pricing theory, and it was developed by Stephen Ross in 1976. To see the intuition for why APT relation must hold for individual assets, at least for most individual assets, suppose that this relation is violated. If APT relation is violated for many individual assets, we should be able to find many securities for which expected excess return is not equal to the sum of factor loadings and factor risk premia. There is going to be an extra term which we call an alpha. Alpha captures the degree of violation of the APT pricing relation. We also think of alpha as a measure of mispricing relative to the APT pricing formula. Suppose that many assets have a non-zero alpha. To be specific, let's say that many assets have a positive alpha. Our argument is going to be exactly analogous if these alphas are negative. Let's collect all of these securities with positive alphas and combine them into an equally weighted portfolio. Call this portfolio P star. The risk premium on this portfolio is a weighted average of the risk premium of individual assets. As a result, we see that the risk premium on this portfolio is given by the average alpha across the securities plus the term that reflects the factor exposures of the portfolio P star. In other words, we were able to construct a portfolio P star for which the APT relation is violated. The risk premium on this portfolio is not equal to the sum across the factors of the factor loading times the risk premium. There is an extra term, the non-zero alpha. What this means is that if the APT relation is violated for a large number of individual assets, it is going to be violated for some well-diversified portfolios. And that, as we concluded before, would lead to arbitrage. We therefore conclude that the APT formula, the relation between expected returns and factor loadings, must hold for almost all individual assets. We will now discuss the empirical implementation of APT and consider a couple of important examples. As we implement APT empirically, we need to take 3 steps. First, we need to choose or identify the common factors. Common factors are the economic variables or their mimicking portfolios that we think affect a broad cross-section of asset returns. At that point, we need to make a choice: how many factors to use and which factors are important. There is no clear recipe for this choice. There are several techniques that could be used. We could use prior information about common economic shocks, macro factors that may be relevant. We could use statistical techniques to help us choose which common factors are important for describing the cross-section of returns and how many of them to use. The choice of the number and the nature of factors is outside of the APT framework itself, so we need to use other considerations to choose the factors. The second step is estimation of factor loadings. We need to use statistical techniques to figure out how various assets load on the common factors. Typically, this is done by running a time series regression of portfolio returns on the factors. The third step is to estimate risk premia. We do this usually by regressing returns on various assets on their factor loadings. This kind of cross-sectional regression reveals the compensation for exposure to each individual factor. At the end, we end up with an assessment of which factors are important for describing the cross-section of returns and how much compensation is earned by various risk factors. As the first example of the implementation of APT, consider a macro factor model. This was the model developed by Chen, Roland, Ross in their 1986 article. In this model, they have several common factors. In addition to the market factor, they consider a number of macroeconomic factors, such as shocks to industrial production, changes in expected and unexpected inflation, as well as changes in the risk premium, which they proxy by the difference in returns between bonds rated BAA and lower and long-term government bonds, and unexpected changes in the term premium, which are the differences in returns between long-term government bonds and T-bills. Their data sample covers the period from 1953 to 1984. The next step in their analysis is to estimate betas on a set of diversified portfolios. The portfolios they choose are equity portfolios sorted on the market capitalization of the stocks. They construct 20 portfolios, starting from the 5% of the smallest firms and going all the way up to the 5% of the largest firms. They run a time series regression of returns on each of these portfolios on the corresponding factors. In this regression, they use 5 years of monthly data to estimate the current value of the factor loadings for each of these portfolios. As a result of this analysis, they obtain estimates of factor betas for each of the factors, for each of the portfolios in their dataset each month. Next, the paper estimates factor risk premia. We have 20 diversified portfolios based on the market cap of the firms. For each of these portfolios, we have estimates of their factor loadings for each of the factors. So each month, we run a cross-sectional regression of portfolio returns on the corresponding factor loadings. The slope coefficients in this regression, the lambdas, estimate the factor risk premia. After running this regression each month, we average the results across time to find an estimate of the average risk premium associated with each of the factors. The result of this analysis is that all of the economic factors used in the model appear to be priced. There is a compensation attached to exposures to all of these factors. We also see that various factors have different prices of risk, and in fact they differ in sign. Some of them are positive, others are negative. The APT model itself does not tell us how and why these risk premia are determined. Why is it that one of the factors has a large positive risk premium and the other has a negative risk premium? To understand where these risk premia are coming from, we need to think about the economics of risk exposures and how they're compensated in the market. Again, the APT as a pricing model is not concerned with the sources of risk premia. It simply tells us that expected excess returns on various portfolios or various assets have to be consistent with each other. They have to be consistent with the factor risk premia. Where these premia are coming from is outside of the model. Having said that, we can make some sense of the magnitude and particularly the sign of the risk premia associated with different factors. For example, if we look at the industrial production, that's the MP factor in the model, we see that the risk premium for this factor is positive. What this means is that the securities that tend to fall in value at the time when there is a negative shock to industrial production tend to earn relatively high returns. This is fairly intuitive. The times when industrial production declines are usually the times of economic downturns, and assets that lose value precisely at the same time when the entire economy is not doing well are less desirable. They have to earn a relatively high average rate of return to compensate the investors for holding that kind of risk. We can think in a similar way about exposures to other kinds of risk factors and why they're compensated positively or negatively with their risk premium. We observe another important result here, that the market factor, the first factor in the table, that's the value-weighted portfolio of stocks, doesn't seem to be priced after we control for the other economic factors. What this means is that whatever economic shocks are driving the market portfolio seem to be captured by the other factors in the model. And after controlling for the exposure to the other factors, exposure to the market is not compensated with an additional risk premium. Our second example is a famous model developed by Fama and French. We're going to use a couple of papers from 1993 and 96 to describe their construction. In this model, factors are not driven by macroeconomic variables, or rather they're not explicitly defined in terms of macroeconomic variables, but instead factors are constructed as portfolios of stocks. In other words, in this analysis, we directly build factor mimicking portfolios rather than starting with the economically motivated factors. Fama and French designed their factor mimicking portfolios by sorting firms on two characteristics: size and the book-to-market ratio. Size in this case corresponds to the market capitalization of the stock, and the book-to-market ratio is the ratio of the book value of equity to its market value. The idea, the premise behind this construction is that firms with different characteristics, small firms versus large firms, high book-to-market firms versus low book-to-market firms, have different exposures to important macroeconomic factors. And therefore, by sorting on these characteristics and by building portfolios, we can construct mimicking portfolios for the underlying macro factors. Of course, we don't quite know what these factors are, but we can nonetheless use the mimicking portfolios in a statistical manner to build factor models. We end up with a three-factor model. The first factor is the value-weighted market return minus the return on a T-bill. We call it RM minus RF. The second factor, which is called SMB, small minus big, is a long-short portfolio, which is long small-cap stocks and short large-cap stocks. The third portfolio, HML, or high minus low, is a portfolio which is long high book-to-market firms and short low book-to-market firms. High book-to-market firms are what is called value firms, and the low book-to-market firms are called growth firms. So this is a value minus growth portfolio. These portfolios, the market minus the risk-free rate, small minus big, and high minus low, seem to earn significant risk premium. Over the sample period considered in the paper, the risk premium on the market is 0.43%, the premium on the SMB portfolio is 0.27%, and the premium on HML, the value factor, is 0.4%. All of these are monthly numbers. We can see that these premia are economically large and they are also statistically significant. We now consider an application of the three-factor Fama-French model. In their construction, they use stocks from NYSE, Amex, and Nasdaq from a period from 1963 to 91, and they built 25 portfolios. These portfolios are sorted on size and book-to-market ratios. For each of these 25 portfolios, they run a regression of the excess portfolio return, that's the portfolio return minus the risk-free rate, on the three common factors: the market factor, the SMB, small minus big portfolio factor, and HML, the value factor. After running these regressions, we can evaluate the loadings on the factors to see to what extent various portfolios have different loadings on the common factors, and the intercepts, or the alphas. If the APT model describes risk premium on these 25 portfolios accurately, these alphas should be close to zero. In the first table, which we take from the Fama-French paper, we see the distribution of average returns across the 25 portfolios, sorted on size and book to market. What we see is that as we go from low to high values of the market cap, portfolio returns decline. In other words, small stocks tend to earn relatively high returns compared to the large stocks. Value stocks, which are the companies with the high book-to-market ratio, tend to earn relatively high returns compared to the growth stocks. In other words, there is a significant degree of heterogeneity in average returns across these 25 portfolios. This is what the APT model, the three-factor model, is going to try to explain. We observe that there is a significant amount of heterogeneity in the factor loadings across the 25 portfolios. While the loadings on the market appear to be relatively similar, the loadings on the SMB and the HML factor are quite different. This is not surprising. The SMB factor is a long-short portfolio of small versus large firms. Small stocks tend to have a positive exposure to this portfolio return, and large stocks tend to have a negative exposure. Similar logic applies to the HML portfolio and the exposures along the dimensions of high versus low market-to-book ratios. The important numbers for us here are the R-squared in the regression of portfolio returns for these 25 size and book-to-market portfolios on the common factors. These R-squared numbers are quite high. They are often in excess of 90%. What this is telling us is that the three factors, the market, SMB, and HML, are doing a very good job at capturing return variation of these 25 portfolios. which is something we would expect in a three-factor APT world because each of these 25 portfolios is well diversified, and therefore their returns should be well explained by the common factors. In this finite table, we look at the intercepts in a time series regression of the returns on each of these 25 portfolios on the three common factors: the market, SMB, and HML. If we compare this to the analysis of the Chen, Roll, and Ross model, this is a different technique. Instead of regressing asset returns cross-sectionally on the factor loadings, we are running a time series regression, where we're regressing each portfolio return on the common factors. Under the APT model, the intercept of this regression, or the alpha, should be equal to 0. Of course, in any statistical exercise, we have estimation errors, and so the intercept in this regression is not going to be literally equal to 0, but we can think about statistical tests of how different these are from 0. We can also think economically how significant these deviations from 0 may be. What we find is that for most of the 25 portfolios, the intercept, the alpha, is in fact quite close to 0 economically and statistically indistinguishable from 0. There are a couple of exceptions that we observe, particularly for small stock portfolios. So what this is telling us is that, by and large, the cross-sectional differences in returns on the 25 portfolios can be well described by a three-factor model. There are some violations that we are observing for small stocks, so perhaps a three-factor model is not a perfect description of expected returns here. Nonetheless, it does capture to a significant degree the amount of cross-sectional variation in returns across these portfolios. We have looked at a couple of examples of how the APT framework can be applied to determine expected excess returns on various assets. We didn't go into the technical details of how exactly regressions are set up and estimated. What we wanted to illustrate is the concept that risk premia of various common factors can be inferred from the history of returns on financial assets. There are multiple techniques that could be used for that: cross-sectional regressions, time series regressions. One of the bottlenecks of the APT is that the theory doesn't tell us where the factors are coming from or how many factors we need. Making those choices requires some understanding of the economics of the problem and further statistical analysis. At the end of the day, APT is a framework which is rather flexible and can be used in a variety of circumstances. It enforces the notion that absence of arbitrage imposes a strong restriction of how expected excess returns are related to risk exposures. This logic is quite robust, and it shows up across a variety of asset pricing models. In this way, the APT framework provides a general template of how risk premia or expected returns can be related to measures of risk.